I'm happy. Recording in progress. I'm happy not to be, yes, it's not the hardcore stuff. There's going to be as few formulas as possible, but I hope that the intuition is something that is of interest. So please unmute yourself if you want to make a comment. I would rather that than sort of monitor the chat. So just unmute yourself. I'm okay with that. Also, there's not a ton of people, so it's going to be hopefully participated. My co-author, Will, is also here. I think Marc will join soon. These are my two co-authors on this paper. Will was at Darden, Marc is at Darden, Will now is at St. Thomas. So all that said, let me just get started. So this paper is, well, the title sort of says it all. A real cost of free trades, retail option trading increases the volatility of the underlying security. I wanted to give it a punchline to start with so that we sort of get the takeaway out of the way. That's sort of what we're going to show. So the research question that we started with was the following. So how does allowing retail investors to trade in levered instruments, specifically option, how does it impact market quality and more specifically volatility of the underlying? So we know that equity investing had seen a significant rise in retail participation, what with the surgence of commission-free brokerages, specifically Robinhood, and then fractional traded. Both of these made trading in stocks very, very cheap. There's been a significant increase in retail participation in the option market. This has been the equity market. The option market has seen a very similar fate, although at a much faster pace and much more recently. So I'm going to show you this in a few slides. There's been a significant increase in the total amount of retail trading in the option market. Now, we know that retail traders are bad at trading. They're going to lose money. That's not going to be a point of our paper. We're going to assume, yes, they lose money regardless of what they trade. That's not what we're going to focus on. What we are going to focus on is the following question. Does incentivizing them to lever their trade using option turn $1, say, of noise into, for example, $1.5 noise, thanks to the leverage embedded in the option? And so does it impose externality to the broader underlying market? Now, this kind of line of argument has been significantly featured in the press, especially during the pandemic, where option retail trading really took off. And so this is so two articles. I'm just going to give you a little bit of a motivating example based on the market or what happened on the market in September 2020. And then I'm going to tell you a little bit about the overall evolution of the market between 2016 and 2020. And then I'm going to focus on one specific event that we're going to use to justify an event study setting, which is when Robinhood introduced options, making them free to trade for all retail investors. Now, what happened in 2020? So already in May, there was a significant attention from press regarding the resurgence of retail trading in the option market. So here they were saying from Bloomberg, darting in and out of stock options, lockdown, socially distant, with lots of time, money to spare, retail investors are leveraging 0% brokerage fees. This was the 0% brokerage fee was an introduction. It was introduced first by Robinhood. They would say that the fingerprints of tiny investors are all over the option market. And they define it as trades consisting of just one contract that account now for 13% of total volume. So that's going to be our measure for retail investing as well, the amount of one contract trades. So that article has a bit of a foreboding end. It said individual investors' active trading is playing an increased role in market volatility. And then sure enough, just a few months later, there's been a significant, a very volatile day on the NASDAQ. And the effect of option markets leverage that can blow up in an investor face was prominently featured in the discussion surrounding the events of September 3rd. Again, in this, this was the day that when this change in NASDAQ was very prominent. Already that day, they were talking about volumes in puts and calls have been exploding in recent weeks, much of it driven by tiny lot sizes. And you might remember that at that time, we're thinking that behind this large amount of option trading, there could be a NASDAQ whale that turned out to be SoftBanks, and specifically their investment in big tech stocks. And so bit of a postmortem the week after this this event took place in September, sorry. Bloomberg would say, the Wall Street Journal will say that there's been giant trades such as SoftBank. SoftBank invested about $4 billion in options on big tech stocks. However, that amount was actually dwarfed by the amount of investing in options that came from retail investors. And so they would say there have been tiny bullish trade of 10 option contracts or less, which are more likely to be individual investors. Retail traders actually spent 10 times what the Nasdaq will had spent, 40 billions on similar trades. And so how would that then how that affect volatility? Well, the idea spelled out, which is going to be the channel we're going to focus on, is through the hedge demand from the market makers. And so in this article, they would point out that option buying is important because it forces Wall Street banks, which sell options to investors, to hedge their position, potentially accelerating trends in either direction. Again, this idea of volatility. When you get rallies and sell-off, option activity forces the street to chase those moves, and it exacerbates move in both directions as street adjusts their hedge. So that's the argument we're going to make. This is similar to Neil and co-authors paper on the gamma hedging from the market makers, but we're going to show that it seems that retail trading has a specific characteristic, which is it tends to be in a single direction. And that's why it seems to have a larger impact on the underlying volatility than other investors, perhaps. So let me give you a little bit of the points I'm trying to make today before I get on with the presentation. And I will try to keep track of time. I know Neil will let me know if I go over, but I just want to make sure that you guys know what I'm going to talk about. So our research question again is, how does allowing retail investors to trade in levered instrument options impact the market quality, specifically volatility? So what we're going to do is, apart from showing you a longer term perspective, we're going to focus on one specific event, which is the introduction of commission-free trading on Robinhood. And we're going to show that stocks for which retail option trading increase, those are also the stocks that experience a significant increase, a larger increase in idiosyncratic volatility. We're going to do that sort of contemporaneously, which of course doesn't allow to claim causality. Then we're going to proceed and show that sorting stocks by an ex ante characteristics that would make them more likely to be affected by a change in commission option trading. Those stocks which are ex ante most likely to be affected are the stocks that show a highest increase in volatility and in option retail trading. You might not be happy with this identification strategy. Look at just like ex ante sorting, and then hopefully we can convince you with the next exercise, which is we'll look at a definitive setting using a set of assets, which are for which the two assets are identical. One of them is going to be affected by a change in option trading and retail trading, and the other one isn't. So we're going to use two different settings. One is going to be based on interlisted stocks, which are cross-listed in Canada and in the US. The stocks are exactly identical. They're just different in the currency that they trade in. The US part of the US denominated stock are going to be affected by this change in option retail trading. The Canadian side not. We're going to show that the volatility of the US market increases more than the Canadian counterpart. The second setting is going to be using dual class shares. These are going to be two class shares written on exactly the same company. Two class shares of the same company. One of them that has an option traded on it, and the other share class does not have an option traded on it. And then we're going to look at the volatility difference between these two. I'm going to show that they increase right around the Robinhood introduction of the options. I'm going to argue that the channel at play is that of option market making. And then we're going to show you the quote unquote so what. So we're going to show, apart from volatility, we're going to show that this introduction of option trading to retail investors has an effect on the volatility of the stock, on the liquidity of the stocks. In fact, those stocks for which volatility increases the most, they also see a large increase in liquidity, not illiquidity, which is consistent with the story of these retail investors being mostly noise traders, consistent with the Kyle model, if you will. Second, we're going to show that the volatility effect that we show is not, we're going to use 5 minutes volatility in most of the paper. We're going to show the results don't depend on that assumption. We can use daily volatility. We get exactly the same results. And finally, this is more of a preliminary result. We're going to show that the decrease in the commission on the option market made options and stock be more substitutable. So there's an increased substitutability that comes from this decrease in commissions on the option market. All right. I don't see any message on the chat or hands up. Again, feel free to unmute if you want to ask a question. All right. Okay, good. So if there's no question so far, let me tell you a little bit about what we do. I'm going to first introduce the idea of retail investors in the option market, tell you about our measure, and show you some longer-term perspective. Then I'm going to go on to the literature review and then focus on the Robinhood introduction of option event. So first thing I want to show you here is just the saliency of the results, meaning do we have a significant increase in retail option trading around Robinhood introduction of options? I would argue yes. So this is the amount of one contract trades, both in total volume in red on the right-hand side, y-axis, and in blue as a fraction of total volume between 2016 and 2020. So we use here as a definition of what is a retail trade, is a trade that has one contract size, fairly easy. So what we show here is that prior to Robinhood introducing options, a very small fraction of overall volume came from this small trade. It's about 2%. As Robinhood introduces this option, that starts increasing. In fact, Robinhood rolled out this option trading being free. It starts increasing and it keeps increasing through 2018, 2019. Then there's another event here, which is Charles Schwab cutting their own fees on option trading. And then retail option trading really picks up during the pandemic. Perhaps part of it was just these people, as we said earlier, being stuck at home. And so there's up to 10% of the volume that comes from these very, very small trades by the end of our sample. Okay. So this is sort of is going to be our left-hand side variable is volatility. This volatility is also increasing, although we're not going to claim that all of the change in volatility came from the option trading. There seems to be a trend that is significant with our story. Now, for it to be significant with our story and with our channel, we should see that the gamma hedging coming from the market makers should be increasing through time and increasing through time because of the participation of retail investors, of customers. And so this is new results, literally from last night. So I hope that makes sense. So what we show here is the gamma hedging coming from different investors. So we have access to data on open and closed trades from different kind of investors, and we sort of accumulate them and aggregate them here. And this specific plot I'm going to show you is for all option trades on stocks which are not part of the S&P 500, so smaller stocks. What we show here is that in red, you have the market makers and the brokers, which take generally the other side, right? And in black, you have the gamma position coming from the open interest of the customers. And you see that that amount, that gamma coming from customer trades, is significantly increasing through our sample. I heard somebody unmuting themselves. I don't know if that was a... No. All right. And so this is significantly increasing through time. The result is also similar for ETFs. This I'm aggregating all the gamma coming from the trading of different type of investors on the options that have ETF as underlying, and we see that this is also significantly increasing exactly in the time sample they were considering. Now, if I want to make an argument about, and this is for larger stocks, it doesn't seem to be quite as significant, but we definitely have a very large increase in overall open interest for the other classes of shares. Now, for our argument to make sense, we should show that is not just, any investor's trade is going to increase the hedge demand from the market makers. What makes retail investing special? Well, what we would need to argue is that they tend to be unidirectional. So they tend to be a significant amount. For example, they all tend to buy calls, and that's why it's increasing the total demand coming from the hedge demand coming from market makers. And so what I show you here is I'm going to aggregate together all option trades on small stocks. On the x-axis here, you have the fraction of option retail trading, and on the y-axis, you have the customer gamma. And so what you see here is that this is the fraction of volume that comes from retail investors, meaning the more retail investors there are, the larger the customer gamma seems to be. And so this is consistent with retail investors taking a single direction in the trades and therefore increasing the demand of hedging by the market makers. Now, this is a very long sample that we are looking at. We perhaps want to focus a little bit on a specific event to try to hopefully get closer to causality. None of this is causal.
So before you go on, let me ask a question from the chat because it's about the measurement. So from Taeyong Park, market makers or banks, auto hedging algorithms may send one contract trades as well. Doesn't this potentially hurt or contaminate the measurement of retail trading?
I think that's a very fair question. I would argue probably it does. I mean, that's the same argument that when we used to have, one contract, one share trades on the stock market, would say, oh, part of it is that high frequency traders. I fully agree. It will contaminate the measure. I haven't quite figured out a way of sort of disentangling the two. I think that's a great question. It's the measure seems to be consistent with what we would expect, right? With this retail investors increasing their option trading during COVID. So the measure seems to be capturing what we think is capturing. You might argue it's capturing something else as well, and it's a noisy measure. And I will take that point fairly and think about how we can disentangle that.
And so sort of a follow-up question from Dima. If retail trades affect the underlying through hedging by options market makers, then post-expiration days should be special as option market makers unwind their delta hedges. Or if you think they unwind on expiration days, then expiration days should be special.
Yeah, that's a very good point. So here we take a very aggregate point of view where just all of our measure of observation going forward are going to be at the stock day level. But we could definitely start thinking more in terms of the days than the Fridays or whatever, when options expire, and figure out if there's something special around those days. I think that's a very, what we're showing here is very aggregate. We're making a point that we can get into the details of this. This is a very good point. Thank you. I'll also take a, hopefully I get a copy of the chat that I can use.
Yes, you will.
Thank you. All right. So in order to try to make some sort of causal argument, what we're going to do is we're going to focus on one specific event, which is the introduction of options or Robinhood, and really try to get as specific as possible around this time. So we look at 6 months surrounding the Robinhood fee change or introduction of options, which happened in December 2017. So in this plot, you have the amount of one contract trades in blue on the left axis, and then the idiosyncratic volatility, right axis in red. And so you see that there is a significant increase in one contract trades around this time. So going back to the question that we saw earlier about whether it's this measure could be contaminated, it might very well be. And so I think focusing on this a narrower setting, I would argue that this is probably retail investing going up around this time. And so you see that as retail investing in option increases, you see an increase in volatility as well. Now, of course, the volatility spikes up before retail trading in option increase. And so this is going to be a contaminated measure again, but some fraction of this volatility might be due to the trading of option of retail traders in options. And we're going to try to get to a more causal argument in just a few slides. But we're going to focus on the 6 months surrounding this event. Now, before I go any forward, I just want to acknowledge we're obviously not the first people looking at this kind of questions. There has been tons of papers on the consequences of retail trading in the stock market. We're going to, so for example, I want to mention a Foucault's paper on the JF that shows that retail trading in the stock market increases volatility. We're going to show a similar result, but for a more indirect channel of the retail traders investing in options. Of course, there's been a ton of literature. Specifically, recently, Svetlana had a paper in this series talking about retail option traders. Rather than focusing like some of this literature does on the profitability of their trades, we're going to focus on the externality that they have on the underlying market. And finally, of course, tons of paper on the impact of options on the underlying, and we're going to try to make the argument that there's something special about retail investors, and that's how they tend to trade and herd. So, coming to the preliminary results that hopefully will convince you that what we're doing, that we're capturing what we're saying we're capturing. Let me tell you a little bit about the data before I forget. So our option data come from the CBOE, covers all the exchanges. Our detailed investor level open close trades come from the Photonoto data sets, which are from the Philadelphia and NASDAQ option markets. Stock data come from CRISP and TAC. We identify retail trading in the stock market when we need to do so, following the, I'm told, I have to say, Bajaz, the Bomer, Jones, and co-author retail trading algorithm. We're going to look at TSX and Bloomberg data when we look at cross-listed shares. And we come up with about 300,000 stock IDT observation following the 6 months around, in the 6 months around the event. We're going to focus on volatility, which is the log of the 5-minute standard deviation of returns, and retail option volume, which is the log of one contract, the log of the volume coming from one contract trades. All right. So let me just start with this very simple regression. So we just, in this setting, in this 6 months around this event, we ask, do we see a positive correlation? Again, not any claim of causality yet, quite yet. If we regress volatility on the retail option volume, do we see a positive and significant parameter? And it does seem to be the case. So we regress volatility on retail option volume measure, as I just mentioned, including stock and date fixed effects, and we show a significantly positive parameter. So one standard deviation increase in retail option volume increases the volatility by about 0.2 standard deviation. So quite a significant increase. You might argue, as we were just discussing a minute ago, that there's nothing special about retail option volume, that any sort of option volume might have exactly the same result. So we control for total option volume. And of course, that is significant, but there seems to be a large impact coming from the option volume, option trades of retail investors. In column 3, we take a slightly different approach. We control for option volume and look at the ratio of retail option volume to total option volume, and the results are still very significant and of similar magnitudes. Now, like I was mentioning, Thierry has a paper in the JF showing that it is retail investor trading does increase the volatility. Retail investor trading in the stock market increases volatility, and Eaton et al. Have a similar paper in the JFE. Here, we then, in column 4, we control for the total amount of retail stock volume and the total amount of stock volume, and also verify that the amount of retail trading volume in the option market is still significantly positively affecting volatility, and we show that that does seem to be the case in column 4. And then in column 5, we add the industry fixed effect, because we know retail investors tend to focus on specific industries. The results still hold. And what I find is interesting is actually that the parameter for retail option volume is twice as large as the parameter for option volume. Again, this is all contemporaneous. No kind of claim of causality quite yet. But how do the stocks that saw an increase in option retail volume differ from the stocks that did not seem to see an increase in option retail volume? So here I define a variable, which is increased option retail trading, which is 1 if the stock is in the top terciles for increasing in option retail trading, and 0 otherwise. And these are just descriptive statistics for the period before the introduction of options on Robinhood. And what we see is that they seem to be fairly similar. There doesn't seem to be a ton of differences. Differences that we see are in the underlying stock price. So options stocks that see a larger increase in option tradings tend to have a slightly higher underlying stock price, and they seem to have a slightly lower volatility. We're going to make the argument that these two characteristics are ex ante predictors of whether a change in commission so significantly affect the likelihood that an investor is going to trade more. All right. Before I do that in a second, I repeat the analysis that I just showed you, trying to show this relation between retail option trading and volatility in a slightly different setting. So here, again, not a diff and diff, because we're doing this increase option retail trading is defined ex post, but we do the following. We regress volatility on stock fixed effect, a diff fixed effect, and a dummy increase option retail trading, which is 1 if the stock sees a significant increase in option retail trading and 0 otherwise. Multiplied by post. Post is a dummy that is 1 after option are introduced in Robinhood and 0 otherwise. And we show that that is very statistically significant and quite large. And so, yes, there is an increase in volatility and in retail option volume for the stocks here. Again, this is not a different results. This is the right-hand side variable, increased option retail trading is defined ex post. But if it was different, it will look pretty good. Meaning after you rescale the volatility of stocks that saw a high and a small increase in option retail trading, and you look at their volatility, which is what I show here. The volatility in red of stocks that saw a significant increase in a significant increase in option retail trading, the volatility increases more than that of stocks that show a smaller increase in option retail trading. However, the two series are significantly parallel, if you will, before the event. Now we can redo the same in the usual sort of definitive setting and show very, very similar results. All right. This is just to show that our results are not, they don't depend on our specific definition of volatility. Here we show exactly the same setting as I showed you 2 slides ago. So like that first column here in column 4, just repeated changing my left-hand side variables. So instead of looking at the 5 minutes volatility, we can look at 10 minutes return volatility, 30 minutes return volatility, 60 minutes. We can even look at open to close daily volatility, aggregating it at a weekly level in column 5 or at a monthly level in column 6, and the results still hold. There seems to be a significant increase in the total in the amount of volatility, regardless of how you define it, which I found quite reassuring of what we of our story. All right.
So before you go on, I have a question about those results, right? So again, from Dima, do you have enough statistical power to confirm the results in a shorter window that excludes the vol spike due to the February 2018 Volmageddon?
Yeah, so I repeat the analysis is not here. I have it. It's yes. So essentially, I kick out everything that happened Volmageddon and that February event and afterwards. The parameter, I think, the statistical significance, of course, decreases because we're throwing away a significant amount of the sample. But it was positive and significant. Also because we're clustering by day, and so you end up having very few clusters. So I need to think about the clustering there. The results seem to be there. I also can exclude the month surrounding Volmageddon and look at the before and after Volmageddon, I repeat the analysis and the results still hold. So it does not seem to be driven by that, but it's well taken. So again, I know I'm doing this thing when I'm telling you it's not a diff and diff and I'm making it look like a diff and diff. But let's try to get a little closer to the actual argument that we're trying to make of causality. So I'm going to show you here some ex ante results, meaning I'm going to argue that that we can sort the stocks along some specific dimensions that I would argue would make them more likely for them to. Well, okay, let me rephrase it. I'm going to ask what characteristic of a given stock will make it more likely for option traders in the stock to be sensitive to a change in commissions. I'm going to sort the stocks according to this kind of forecasted sensitivity to change in commissions. I'm going to show you that the stocks that were less likely to be for which investors were less likely to be sensitive to change in commissions are the stocks that saw less of an increase in volatility and less of an increase in option retail trading. And of course, the other way around for the stocks that were more likely. And so hypothesize what could be this characteristic such that the option investors will be sensitive to a change in commissions. I'm going to make the following argument. Hypothesize that the change in retail trading commission will matter less the more expensive the option is compared to the stock price. So if an option is very, very expensive, it really doesn't matter if there's a 5 or a 1 or a $0 commission. If options tend to be very, very cheap, then I'm going to be, as a retail investors, very, very sensitive to a change in the commission. Of course, if the commission makes up 40% of what I'm going to spend, when that commission goes to 0, I'm going to be more likely to be trading. All right. So we do the following. We calculate essentially the ratio of call to stock, and we show that is increasing implied volatility. So we source stock by implied volatility, making the argument that stocks that have very high implied volatility also have a very high option price compared to stock price. It's hand wavy now. I'm going to get into more sorting in a second. But we do this. We define high implied volatility as being a dummy equal to 1 if a stock is in the top tercile by implied volatility and 0 otherwise. Our argument is that those stocks with very high implied volatility, their options are very expensive compared to the underlying stock. So they're going to be less sensitive to changing commissions because the commissions are relatively smaller compared to the total price of the option. And so those stocks will experience, we would argue, a smaller increase in retail option volume, and also therefore a smaller increase in volatility. And that's what we show here in the first column. We show that they experience a smaller increase in retail option volume and a smaller increase in volatility right here. We can make we don't have to just take back and shoulders and calculate C over S. We can say, okay, let's look at actual retail, one contract trades for options, calculate the average of those option prices, and calculate the average of those option prices as a fraction of, and divided by the price of the stock. Those stocks that have a high options to stock price ratio, also they have very expensive options again, and so they're going to be less sensitive to change in commission, and therefore they should experience less of an increase in retail option volume, which is what we show here in column 2, and less of an increase in volatility, which is what we show here. And I argue that we're putting a lot of things in this ratio, right? There's many different characteristics of a stock that might affect their option to stock price. And so we do 2 things. First of all, here I was telling you I calculate high IV and collect 1 if the stock is the top tercile and 0 otherwise. Well, I can do the same result instead of just looking at the top tercile versus bottom 2 terciles to all the, say, quintiles of this measure. And I show here the results that so this is the rank of option to stock price to the left, in the left part of the table, and that the changes before and after Robinhood introduction in volatility and retail option volume, and these are monotonically decreasing in the rank, both for volatility and for option volume. I can do 2-way sorts, right? So I can sort all the stocks by the stock price, and then sort them by their implied volatility. And I can show that. Let's take the last column here in this table. These are the changes in the top part of the table, the changes in retail option volume for stocks. Those are around the introduction of option in Robinhood for stocks in the highest quintile of stock price. And then as their implied volatility increases, their option become more expensive compared to the stock, holding that sort of stock price constant. And we see that as implied volatility increases, the change in option retail volume is smaller. And similarly, the changes in volatility. I'm looking at that last column here of the table. All right. So these are, again, ex ante sorts. You might argue that it might be capturing something completely different. That is not what we're trying to capture, this propensity to a change in commission to matter for retail investors. And so we're trying to get a little closer to an argument of causality. How can we do that? So we would like a diff and diff setting where we have 2 assets being exactly identical. They are the same exact claim on the same exact cash flows, but they differ in one fundamental dimension. One of these assets is going to be affected by the change in the change in commission Robinhood by so it's going to experience an increase in option retail trading, and another asset which is not going to experience an increase in option retail trading, despite these two assets being exactly identical, apart from the change in option retail trading. Where do we look for this? It was challenging, but I think we came up with two fairly convincing empirical strategies. So there are 66 companies that are Canadian companies, which are cross-listed to the US in the US market. And so their shares are at the same exact identical asset. They're the same exact claim to the underlying cash flow. They just happen to trade in US dollars in the US and in Canadian dollar in Canada. So Precision Drilling will have a share traded in NASDAQ, a share traded in the Toronto Stock Exchange. That's exactly the same share, just happen to be trading into different currencies. Only the US dollar denominated shares are available to the Robinhood investors. So last night went on Robinhood, checked Precision Drilling. I can access Precision Drilling in US dollars. I can trade options on Precision Drilling that trade in the US stock market, the US option market. I cannot trade Precision Drilling in Canadian dollars, or the options on Precision Drilling that trade in Canadian dollars. Okay. So the argument here is that these two assets are exactly identical. One of them is affected by the introduction of Robinhood, of options in Robinhood, the other one that isn't. And I see that Louis has a question. I'll get to that in a quick second. Let me just show this result. And so we do the following. We take the volatility of the 66 by 2 stocks in Canadian dollars and US dollars. We look at the intraday volatility of these assets, and we perform the following regression. We include stock by country fixed effect, time fixed effect, a US dummy, which is 1 for the US stock, which is the one impacted by the introduction of options on Robinhood, and 0 for the Canadian counterpart, pose, which is 1 after the introduction of Robinhood and 0 otherwise. And we run the following regression. So what we show is that these two assets, they're exactly the same claim to the cash flows. One of them is affected by Robinhood introducing option, the other one isn't. The one that is affected shows a significant increase in volatility of about 7% compared to the volatility of the corresponding Canadian dollar denominated stock. In this case, because of how we're calculating the returns, FX that cannot be driving these results. So Luis, can you, do you want to say your questions?
Yeah, sure. Thanks for the opportunity. So,
so
these stocks trade simultaneously in Canada and the US, but their prices are not necessarily equal on an exchange rate adjusted basis. Every now and then price differences occur, and they tend to persist for a variety of reasons. Some persist, some don't. So I wonder if your empirical results are sensitive to the emergence or the appearance of such price differences over time. And also, I'm interested in knowing if the share of trading volume, say of overall trading volume that is based in the US, say, has any impact on your results as well.
That's a great question. We have not checked that. I'll be frank, in terms of just say putting the volume on the right-hand side, we have not checked that. We can definitely do that. What we do is we include stock fixed effect, so that unless there's some changes in volumes around exactly this time, it should be probably, if there's a cross-sectional differences, it should be picked up by the fixed effects. But of course, if within the same cross-section, there's a time event that relates to volume, we're not capturing that. That's very fair. Regarding the difference in prices, my job market paper from many years ago, looking at that, we have not recalculated this for the specific sample. But what I can show you is the following, and I hope that partially addresses what you have in mind. So here, So anyway, this is statistically significant. We can do the same. We can take the difference in volatility and regress it on FX volatility, and we show that that's not what's driving our results, as I just mentioned, because volatility of the FX drops out. But coming to these questions, what I show here is these are not like definitive parameters. This is literally in red is relative difference in volatility for the Canadian and US dollar denominated stocks. Okay. And that difference in volatility is essentially zero. That's the right-hand side y-axis. Is essentially zero prior to the option Robinhood introduction of options on Robinhood. And in this plot, I show the amount of one contract trades in the US option market. And these two series are 70% correlated. So the way I interpret this is this red dots is a measure of excess idiosyncratic volatility. And in blue, you have instead just the fraction, the prevalence of retail trading in the option market. And so these two are, can move to an extreme degree. What I found was very interesting is that if I compare it to this guy that I showed you earlier, remember how I told you, oh, this red volatility here, there's a lot of things going on here that is absolutely unrelated to what we're trying to show. And I hope that you buy the argument that this measure of excessive idiosyncratic volatility is much closer to what can be actually driven by retail investing in the option market. So we do this in this specific setting with this cross-listed. We repeat it, and this is just the usual. We repeat it in a slightly different setting. So what I mentioned earlier is, so there are 13 companies here, the samples are getting smaller and smaller. 13 companies that have two share classes, both of them trade on exchange in the US. These are all US companies. Both of them trade on US exchanges. One of the two share classes has an option written on it. The other share class doesn't. And what we argue is that the share class has an option written on it is going to potentially be affected by this introduction of retail trading of options to retail traders, whereas the share class that doesn't have any option written on it, of course, is not going to be affected. And what we show here is this is similar results. So this is significant, is a 13% increase volatility instead of the 7. But here we show in red this dual class volatility differential vis-a-vis the one contract trades volume. And again, this seems to move to a significant extent. And so the way I would like to interpret it, but of course I am open to alternative interpretation, is that this measure of excessive idiosyncratic volatility in red coming from this definitive setting is driven, and significantly so, by a change in option retail trading.
Let me jump in and give you the 10-minute warning.
Thank you. I appreciate it. See, I told you I had 21 slides, but in truth, they were 75. So you can make the argument that this results that I just showed you for the cross-listed Canadian sample, the same sort of ex-ante sorting, the same ex-ante propensity for commissions to matter should matter in this setting as well. And so I repeat exactly the same analysis where I do a triple definitive. It's treated for the US post and then interacted by this measures, which I would argue capture whether commission a change should significantly impact investors' decision between trading between options and stock, and the results are again consistent. A little bit about the channels, a little bit about the effects, and I'm going to conclude with what's next and show you this preliminary result on the substitutability between options and stocks from the point of view of retail investors. As far as this channel are concerned, I go back to this increased option retail trading dummy, and I show that those stocks for which option retail trading increases more, also stocks for which market makers buy volume increases more. There are also stocks for which the total amount of retail call buy minus retail call sell, which is again another measure of a proxy for hedging demand from the market makers. They increase more for the stocks with high option retail trading and less for stocks that don't see the same increase in optional retail trading. Again, these are, of course, ex post result. I can do the same sort of propensity argument, and the results are very consistent. You might realize if you don't buy the propensity argument, half the paper doesn't hold. But if you buy the propensity argument, then you should be hopefully comforted by the fact that the channels that we have in mind seems to be at play here. Now, let me tell you a little bit about what else we want to look at, the effects of this increase in volatility on other measures of quality. And so if what we have in mind is true, which is retail investors manage to be more noisy thanks to the embedded leverage that is embedded in the options. Well, if that is true, and you buy the Kyle model, as I think we do, then we should see that those stocks that have a significantly more increase in noise, they tend to become not more illiquid in the direction that normally is there between volatility and liquidity, but actually more liquid. And this is exactly what we find. So those stocks that saw an increase in option retail trading tend to have smaller quoted spread, effective spread, realized spread, and price impact. This is in the stock market. However, again, these are exposed sorting. I can do the same because of the in the dual class sample. I can observe exactly the same quantity for both the two kind of share classes, and I show that the results are here also in that sample, which is arguably closer to being a well-identified sample. All right. The last results that we have, which I would like to show because I would like to get your feedback on it, is the following. I was thinking what I would like to look at next is how retail investors, how the decision of retail investors whether to trade in a given underlying stock or in the option written on that underlying, how is a change in commission going to affect that choice? And so what I thought could be the case, and this graph seems to be confirming that, is that once commissions go to zero, the options and the stock are more closely substitutes, right? Because I pay zero to trade the underlying. I used to pay a hefty commission to trade the options, and now I pay zero commission for trading the option as well. So I'm going to be more likely to substitute one for the other. So what we do here is the following. For every day in our sample, we calculate the rank correlation cross-sectionally between all how many ever tickers we have of to measure the fraction of trading in the option market that comes from retail investors and the fraction of trading in the stock market that comes from retail investors. Calculate that cross-sectional rank correlation and plot it through time. If what I say is correct, we should see that retail investors tend to substitute more freely between options and stocks once there's a decrease in this in option trading commissions, and this seems to be what we see here. So what we see here is this cross-sectional correlation increases after Robinhood introduces options, suggesting that investors might see options and stock as closer substitutes to get exposure to a given company's cash flows and underlying. All right. So that was all that I had to share. I think we're in good time. So let me just wrap up real quick and then open the floor for whatever questions there are. There has been a significant, I would suspect that the advent of low fee trading in options should affect retail traders' welfare. That's all very fine and good because they choose to trade in this market themselves. What I think is more interesting is if we manage to make an argument that allowing retail investors to trade an option has an impact on the underlying quality. I think that externality argument is a powerful one. And so what I would like to do next is to I'll take all of your comments. I'll address the questions regarding how precisely our measure is doing its job. I'm going to dig a little deeper about the gamma hedging results that I showed you at the top of the presentation. And then I really want to look at this trade-off decision from the retail investor perspective between options and stocks. That was it.
Okay, so at this point, we'd like to invite anyone who has a question or a comment to unmute him or herself and you feel free to use your microphone. So feel free to shout out your questions. So go ahead, please come.
Steve, we seems to be having a problem with your microphone.
Yeah, we have an audio problem. I can't hear you.